So like I said, tonight I'm going to talk about butterflies and why they're important, but we'll go and get our disclaimer out of the way. And as you know, Random Walk's not a broker-dealer nor investment advisor. Please be careful putting any trades in your platform, paper or real. Actual P&L can be affected by liquidity, commissions, slippage, all that kind of good stuff. So, like I said, be careful out there. And but like I said, the markets have been going crazy, and this will be recorded and get this posted out there if you're out and about. Fall season's almost done here in North Carolina, but got another week here, and I should be in the clear. So, that's my nemesis is the darn pollen every year. Anywho. Tonight's topic, like I said, butterflies, thriving in high volatile markets. As you know, the markets have been going crazy with all the tariffs. We're up 40, down 50. It's been good to us from a standpoint of Venus butterflies really thriving. But tonight we're going to talk a little bit about, what is a high volatile market? Why is the short ratio in a butterfly important? What kind of strike should I use in my butterfly? What are some of the other factors to consider in building a butterfly, and how to optimize our butterflies for maximum performance? We want our butterflies to pull all their weight, so every leg in a butterfly is important to us. So what are high volatile markets? High volatile markets are typically when markets move quickly versus their historical performance. The market makers, they got to account for this, and typically you're going to see, larger bid-ask spreads, and some of these spreads here lately have been, larger than a Mack truck. This is why I always say stick to your guns with your risk reward, because, doesn't matter what you see on TOS, don't believe what you see there. Stick to your guns as far as what you consider a good debit spread or a good credit spread, and go with it. But we can look at the option chain. It can to kind of narrow that down. But if you stick with a good risk reward, you should be okay. But you always don't do naked options, whether it be long calls or short options. Do spreads in these higher IV environments. But the higher IV rank in general is going to allow bigger butterflies to be created, because you're getting more premium on the short strike in a butterfly, because you're short twice as many strikes in the butterfly than the longs. And at the end of the day, as a trader, you have to choose between your risk reward and how much credit or debit you want to receive. The two-sided markets make directional trading butterflies fun in our regards. There's a lot of terms I may throw out here with butterfly terms. If you need it, we do have a glossary. You can just shoot me an email, ed@randomwalktrading.com, and I'll send you a copy of our glossary we've had for years here. But we use some terms here that you may not hear, like Venus butterflies, outer and inner butterflies, that type of thing. But directional butterflies is what we call Venus butterflies, and we're going to dive into that here just a little bit. But you can start with these directional butterflies and then use the price movement to help lock in some monies, or if you want to leg into butterflies, you can do that as well. So, why trade the butterflies versus spreads? And like we've mentioned before, the increase in implied volatility levels allows you more credit received when selling, these options. And like I said, the faster the markets tend to increase these IV levels, and the butterflies, butterflies consist of basically a long spread and a short spread. You combine them together, you make a butterfly. Many people know what broker wing butterflies are. That's probably the most common type of butterfly, but there's 1, 3, 2 butterflies. We talk about the Venus butterflies. We also got bionic butterflies. But all in all, what we're saying is the short spread in a butterfly, and that's what I'm going to call the short ratio. If it's less than 10%, then you're just better off buying the vertical, because the credit you're receiving on that short vertical in the butterfly is not really helping you out, right? Because that extra premium will do one of two things. One, it can reduce the cost of the butterfly, which is good, or you may elect to do a larger butterfly, so you're more bang for your buck. So, no, it's just trader preference. But we'll get into all that fun stuff here. Look at these crazy markets. We've been zigging and zagging, and we're up one day, down the next. Getting the earning seasons here, but on the weekly chart here, let me get my pen out here. We have the weekly chart. Oops, here on the left. Then we got our daily chart. We got an upward trend going on here on the weekly chart. We bounced off of 61.8, and now starting to go up. We do have a downswing here, but now we're starting to work our way up here. This 56.36 can act as some resistance, and if that's the case, then we could potentially fall back down. We don't want to scare the kids, but 45.25 would be the downside target if that proves to be resistance and continues to retrace. Again, nothing is 100%, but just looking at our tea leaves, that's what we're seeing for right now. So the other question that comes up is, how big, do you make your butterflies? It's basically the two ways a trader can use the butterflies. Either you're going to use them as a directional type play, you're bullish or bearish, or you're kind of non-directional, and you do a broken wing butterfly. And your strike selections, they can be based on some deltas, they can be based on the probabilities, standard deviation levels, IV levels. It could be a MACD, a squeeze, support resistance, all that stuff. That all falls into the technical camp. But when we're conducting or constructing a butterfly, like I said, that short vertical in the butterfly, we want to make sure it's pulling its own weight and contributing to our overall strategy, because you can give up a lot of profit if you're not getting enough credit out of that short ratio or the short spread in the butterfly. So generally what we'd like to do is to take a position and either collect a credit and wait for time decay. That'd be your broken wing butterfly, which is going to be your positive theta. Or you can use the directional butterflies, aka Venus butterfly, to take quick profits or lock in monies with more butterfly than spread. This is where the pregnant butterfly strategy was born here. I guess 5-6 years ago we developed that, and that's a good Swiss Army knife in these type of markets, because markets can gyrate very quickly depending on the market news. And which way the wind's blowing, the market could be down 100, and the next thing you know, it's up 20. This may be a little bit of an eye chart, but just showing a particular trade here. And what I want to zoom in here is this is just a trade that we're going to look at. It's just a Venus butterfly here, 54.30, 54.10, 5400. And we're going to pull that up in Think or Swim and take a look at it and see what how's that constructed. Right? We're going to go back to the basics here, and in this case, we're taking that trade, and the Venus butterfly is has a in this case a debit spread of $4.30. The total cost is $2.35, and I've broken out the two trades. So so you put one here, two here, so $4.30, which is a debit. And if we're controlling, multiply by 100, $430, and the amount of credit we're getting on the short spread is $1.95. If you subtract the two, you're going to get the magic $2.35, and that's going to be the maximum risk in the trade per contract. And in this case, we're just doing a single contract, and just kind of broke out the two verticals here so we can kind of play that out. But that's kind of our basic definition here for a Venus butterfly. Taking a little bit closer look here, like I said, the short ratio is the amount of credit received by the strike width of the spread, and if that ratio is less than 10% of the trade, you're not really getting enough, credit, so to speak, no pun intended, for the risk that you're taking. So in this example, the 54.10 and 5400 spread that we just looked at here, we get $1.95, right? But remember, if I'm getting, we'll just round this up to $2 just to make the math easy here for a second. If I'm going to collect $2 on a 10-point spread, what am I giving up? You know, the risk or the trade-off is going to be the difference in the strikes here is, you know, $10 minus 2, which means I'm giving up basically $8. You know, if the trade goes against me, if this is just a put credit spread, you know, you can collect $2, but your risk would be $8. And the general rule of thumb is we say, hey, 1/3 the width of the spread. In this case, $3.33. So 10-point spread times 33.33, 333. And then minimum, you know, would be at least $1. And in this case, we're kind of right in kind of the middle. It's not the greatest, not the worst, but nonetheless, it does give us, you know, some idea of, you know, paying attention to the short ratio, why it's important. And like I said, if it gets to be less than $1, then you're just better off just buying a long put spread, or the long spread, I should say. And I say put spread because we're bearish in this case, but if you had a bullish trade, then you're better off just doing the call spread. All right, so, you know, what are the other things that we need to take into consideration? It's going to be, you know, obviously IV rank is going to be the, you know, how much IV is coming into the market, DTE or days to expiration. As you get negative, you know, Vega, you know, when the market was really tanking a couple weeks ago, you know, when the IV rank is around 60 in the SPX, which is great, and you know, we're down below 30 now, so you can see how quickly that comes off. But there's skew, you know, put skew. As the markets go down and you get higher put skew, you can take advantage of that. And you know, there's techniques that we use, obviously, to take advantage of that higher put skew, whether it be an adjustment most times. Probabilities, also another factor there. You know, the you know, plus or minus 1 standard deviation, plus or minus 2 standard deviations all come into play. So ROI, how much ROI do you want to get out of your butterfly, and of course strategy. You know, what type of butterfly or trade strategy that you want to put on in your butterfly with all the different variations that we have. Here is a very high level chart showing on the downside here, and the x-axis is the break evens. So if you're at the money here, this is as you go further out of the money on the call side, and then further on the money on the put side, and then the ROI is our y-axis here. And what we got here is we're just graphing different types of butterfly spreads. We got spreads, Venus butterflies, wing 132s, bionic flash, and here we're just highlighting a particular trade here, and then we're going to, you know, take a look at that and say, okay, how does that compare to what we have? And better butterfly is going to be a relative term here. And I don't like to say depending on, but it depends on, you know, what a trader's perspective is, and you know, how much credit do you want. Some traders, you know, you want to put a butterfly on with, you know, at least a little bit of credit, you know, maybe a quarter. Others going to want to do bigger butterflies. It's just trader preference, and what you consider what the market may do. So we're going to take a little better or closer look at that. And so here we're clicking on a Venus butterfly here, and we're going to take that guy and compare that to what we did earlier. And if we pull this under the chart, I left the original example that we did here, and we just kind of pasted it in here. And this one is $1.95, where the long put spread here is $3.65. And then the short spread here is the $1.70. And if we subtract the two, we're going to get the $1.95 ratio. But more importantly, this spread here is $1.70. So if we take the you know, what is that short ratio? Well, it's a 5-point spread, you know, with $1.70, and that turns out to be a 34% short ratio. So we meet that criteria. You know, many times, you know, the tasty traders like to have, you know, 1/3 the width. You know, it's a good back of the napkin calculation. You know, for credit spreads. You know, if we're trying to if we have a long spread, we try to get out at 80% ideally. We may cut and run earlier, but for credit spreads, in this case, as we're talking about short spreads in a butterfly, this is the number we're looking to come up with here, because while this is 34%, again, what's the trade-off, right? If it's a 5-point spread on $1.70, if I take 5 minus $1.70, that's going to boil down to about $3.30 that I'm giving up, and that is what this does, right? So the more credit I get, the cheaper this will become, but the trade-off is this will get flatter. If you want to have this higher, you can probably get less credit, and that's, if you get less credit, then you're better off just doing the vertical here. So that's where this comes into play as far as the amount of credit we're getting on this short put spread on the downside. All right. So here we can kind of look at a recent class example and kind of walk through it. We did this a couple weeks ago. This was a trade that we did in the S&Ps using the April 25th expiration. And in this case, we just did a simple Venus put butterfly. We did a 5-lot, and we paid $7 for this Venus butterfly. So, all in all, we have $3,500 of risk in the trade. The market then decided it was going to go down, which was fine. So we did an outside stacked butterfly here. We received a $10 credit. That does induce margin down here. I'm not negating that. But while we're down here thinking, hey, we might get a bounce, we did the same thing here on the upside, and we bought 10 Venus call butterflies for $350. So we collected $10K for the outside stacked butterfly, and we spent $3,500. So net, we raised the middle of our risk graph up, which is good. So that was the two things that we did there to kind of just take advantage of the movement, because as traders, if you're playing direction, you need the market to move, right? And the worst, I don't say the worst scenario, but the frustrating part, I know 3 or 4 years ago, I forget, it was the summer, and the market really didn't do anything. We had several days where we did less than 10 points in the S&P. The IV rank was like 9. I mean, it was brutal. The poor butterflies were just starving. There's just no meat, no short premium in there. So, but now we've got the opposite, which is nice. But we want the market to move, and that's what we're trying to do. We're trying to capture the movement of the market, and with that movement, try to lock in some monies with the trade adjustments that we do. So day 4, we went ahead, market it moved higher, and we bought, basically in this case we bought 5 put butterflies for $4, and that removed that $7,500 of margin that we had. It did pull the middle of our risk graph down. So now, worst case scenario, you got $1,000, win, lose, or draw, and we still got 21 days left in the trade. So again, taking advantage of movement. The movement, continue to go up. Day 5 here, the market continued to go to the upside. So same kind of, or in this case, instead of doing an outside stacked butterfly like we did on the put side, we just sold some more of the call spreads. Now in this case, this is a 25-point call spread. We did it and sold it for basically $15, and that $15 times 5 is $7,500. So we collected some premium, and then with some of this premiums, again, always looking to see where the 1 standard deviation is, and also paying attention where the 2 standard deviation is. And in this case, we bought some inside stack butterflies for $1. So we spent $1,000. And now, worst case scenario, we got $2,500. Everything's above zero. Life is good. Sit on the rocking chair, whatever. Drink some lemonade, your favorite beverage, what have you. So we're just going to let the trade kind of keep on working here. And so on the 10th day here, the market could kind of continue to wobble here on the upside. Come back out. So as the market is continuing to kind of work its way up here, we sold another, 5 call spreads, same strikes. I could have done the full 10 contracts initially, but I didn't know how much further the market was going to go. Here, we thought, hey, we're about to get to the top. So on the second set of the call plans, I only got 1475. And in this case, instead of buying another butterfly, I just did 10 put spreads, $1.50. And this is basically a 15-point put vertical that we added in front of the butterfly. So we pulled in, roughly $7,500, and then we spent $1,500. So that's $6,500. Again, boost the risk graph up, and now we're looking at roughly about almost $8,400 in monies there. So. On the 11th day here, the markets, again, we're slowly churning. We didn't have the rapid move to the upside, but we kind of just sit and churning here. So now we're starting to, we're in the money on this butterfly here. We turned it into a broken wing, and we did just, 5 lot here. So it is a 10-point spread, and we sold 5 for basically $750, so a little over $3,700. Same thing, using some of that money there. So if I got $3,700, I took a portion or proceeds of that. In this case, bought a 10-point put spread and added it at the base here, because I'm paying attention at the 1 standard deviation, the 2 standard deviation. And we always want to pay attention in this area, because as I've mentioned many times before, when the market is calm, right, and we don't get a whole lot of movement for week, 2 weeks, the IV starts going down, and it's like, okay, everything's fine and dandy. But when the market rips or it decides it's going to have a volatility spike, it usually doesn't end at the 1 standard deviation. It usually quickly goes to the 2 standard deviation, because the IV rank is already low. So it's not going to take much to really get it to spike up. So always paying attention to where that 2 standard deviation mark is, and if you're happy where that lands on your P&L, great. But if you got a broken wing butterfly and that's max loss, you may want to take a look at it. So like the check engine light on the car, make sure everything is okay. Is there a potential trade thing that we can do there? Taking it to the next day here. Again, I got a little bit of wobbliness here. The markets did pull back a little bit. Here, about 9 days left to expiration. Did know that we had some upside margin that I wanted to address. So as the market started to retreat here, I kind of nibbled a little bit on this outside leg here. This is again a 15-point spread. I bought it for $350, so I spent about another $1,750 here. But in this case, with the down move and this large butterfly that we had, I just kind of nibbled here, and we sold, in this case, a 10-point spread for $2. Now that's not 1/3 the width that we've been talking about, but I wanted to pull in some premium, because in the case here we're spending $1,750, and it's like, okay, where's the $1,750 going to come from, right? I could pull it from the kitty here, the monies that we got working here, but I was willing to give up a little bit of profit here on the downside. So by selling that for $2, I collect basically almost the same amount of monies. So it really cost me $350 to make that adjustment. I collect some premium, and I'm using the premium here to kind of help pay for this guy. And like I said, with 9 days left, try to, this is where the majority of our risk is. If we, get some kind of high flying move to the upside, if we rip to the downside, fine, because here's the 1 standard deviation. This is fine. We'd be happy to land. This is close to about a 98K butterfly. If it decides to go to the downside, we'll take it. On day 13 here, the markets kind of just weren't going anywhere, and we didn't see any kind of real movement, which way, or we didn't see which way the markets wanted to go. Obviously, we're down to 8 days to expiration. We got almost 150 points here to our break even on the upside. And in this case, buying, adding another spread here, didn't really need to. We're at the edge of the 1 standard deviation, so I bought on the outside here, and this is just again, in this case, this is a 50-point spread. Paid $1 for it times 5, so I spent $500. But that lifts this outside leg up, and now we got a really nice Venus put fly. If the market decides to tank, if it lands here, we'll take the 95K. But again, we don't know. We just got to play offensive defense here and play what the market kind of gives us here. On day 17 here, we're 4 days left to expiration. The markets did go down, so we did two things here. So you can see that with the down move, and only 4 days left, I wanted to cash in some of the monies. So I, in this case, sold 20-point spread for $4, and that obviously reduced from 95K or 98K where it was down to 80K here. So but did it 15 times. So just basically shifting the short strike there. So pulled about $6,000, and then took some of the monies. And in this case, I added a long call vertical outside the 1 standard deviation that eliminates this margin. Because remember, this is a call vertical wing butterfly, but I added the call spread here. So now we got a hybrid, Venus call fly to the upside. We'll take it. So, but now we're sitting at worst case scenario of a 20K profit. And then again, we're still rooting with our pom-poms and cheerleading uniforms here to say, okay, we still got 85K potential here on the downside, and we do have roughly 70K here if the market wants to rally. We'll take it type of thing. So. All right, day 18 here. So this is April 22nd. We got 3 days left. The markets decide that they're going to rally this day, and with the move to the upside, we had a long call spread here, and this type decided to sell some call premium against it. This is a 20-point spread, collected $6.25 times 5, so it's a little over 3K premium. Apologize for my scribbles. So we did that, and basically it's a symmetrical call butterfly, and then the same thing here. Took some monies because here's the 1 standard deviation. I had nothing here, and I bought a small Venus put fly for $1, so I spent $1,000. So net, pulled in another 2K. So now we're sitting, worst case scenario at 22K profit in the market. Comes to the upside. So again, we're either rooting it for it to go on the upside, or if it wants to go to the downside, we'll take it. So that's what we had in the hopper there. All right, day 19. So this is April 23rd. We got 2 days left to expiration. Markets decided to zoom up into our butterfly. Life was good. But in this case, so the markets are rallying. You can see that our window, or the plus or minus 1 standard deviation window, is shrinking, which is the case, typical, because you're getting closer and closer to expiration. So this will get narrower and narrower. We did two things here. One is we added a dollar put spread here. In this case, the 52.05, 51.80 for $1. We added that in front of this Venus fly that we just did. And in this case, on the call spread, I didn't have to do it, but again, I just, with the whippiness in the market, we blew through this. This was a symmetrical butterfly. We blew right through it, right? So this spread here, I'm really making a really wide pink line here. I apologize. Magenta here is this in the money call spread. So it's 25 points wide. So the max I can get out of it's $25. I decided I'm just going to take the money and run. It's 4 contracts at 20.25, so a little over 8K profit. And then I spend $500 to buy this long put spread. So now we're sitting, closer here in the middle here with basically 2 days to expiration. Getting $200 or $233 in positive theta, which we'll take. So what does the market do? So now we're the day before expiration. We pull back a little bit. So I did a couple things here. I spent some monies to buy this long put spread. It was 53.80, 53.70. This was basically a 10-point spread for 225. I did a 5 lot, so a little over $1,100. And then the other thing I did is to try to milk out some of the premium in here. I could have sold this first little chunk of the butterfly, but then that would do some more margin here to the downside. So this is where we go to our tool belt and our toolbox here. This is selling a call condor. So this is basically for $5. We did a call. We sold a call condor here for $5. Pulled in $2,500. So now we're down to a $15,525 worst case scenario. So we keep massaging it, using our layer spreads to work the trade. And then the next day, the market decided it's going to continue to zoom higher. So going from inside the butterfly and going to the upside. So we just basically ended up with a 15K type of winner in this scenario that we had. That basically would boil down to in 21 days, 15K winner. What about $7,500 in risk? And then from that risk, you can equate to basically a 206% return. So like I said, here was just a simple example of why we love butterflies and all their butterfly variants. And like I said, we talked about the one component we like to use is a gauge on our dashboard is the short ratio, which is the short spread in the butterfly. And how do we determine how to select it? You combine that with your probabilities, your ROI, your days to expiration, and then we can kind of tweak the butterfly to kind of fit your strategy. And then after the entry, use your layer spreads trading belt to increase your profit areas or reduce the risk in the trade. So that's just kind of a simple little example. And if you're interested in joining, this is our link. It's $59 a month, and meet every Tuesday, and all sessions are recorded. You got a Dropbox for all the trades and screenshots. We have a Discord channel, and on Fridays we do a live trading room from 1 to 4. Talk about potential trade adjustments. Maybe do a 0 or 1 DTE type of trade, and why I'm taking particular strikes, or when I'm looking at the market. Because the other part of it is reading where the money's going, and that's more more price action, so to speak. I mean, I love indicators and everything, but learning to read the price action and the correlations with different asset classes will kind of help. Again, trading in the zone, Michael Douglas. Trying to find an edge in your trading, very important. But like I said, if you need a copy of the free butterfly glossary, there's my email. Just shoot me an email, and I'll send you the PDF of that. We do have an Excel RTD dashboard that's in our online store, and the Options Dashboard Pro is a new product that's been about a year in development for release here in July. And I'll go over that here just a little bit, give you a little demo or under the hood sneak peek of that. But it does work with TastyTrade API, and it also works with Schwab, so it works with either platform. I'll show you that. It's going to rank your trades. You can look at different strategies, and then you can copy and paste it into TOS for easy analysis. So we'll do a little example of that. Let me switch screens here and just pull up sneak peek or coming attractions, I guess. So if you're familiar with the Excel RTD dashboard I did that about 8 years ago. This has been in my head for 2 years, and about a year ago I finally pulled the trigger on this. So it's sort of like that dashboard, but on steroids. So this is like the Ferrari versus the Ford or the Chevy pickup that we had. I mean, they work. It works well. It's RTD. This one's not RTD, but I'll just kind of walk you through how I use this. So So in this case, we got a stock of the S&Ps. We've got different expirations. It will tell you all the different expirations out there, so you can switch these to different expirations to your heart's content. Change the strike width. You can change the number of contracts, the strategy. So similar to my other dashboard, you can, if you just hover over it, it tells you the strikes. It'll give you some information on that. If you don't want to do the Venus butterfly, which is a 4 strike by 2 strike, you can pick 5 by 4, and it just updated with everything. So now we're looking at everything with 5 by 4 strikes, which is kind of cool. We got the deltas, the call and put deltas, along with the pricing. We'll talk about the graphs here, and we'll talk about switching modes here in a second. You can set your short ratio. It defaults to 1/3 at 33%. If you want to go to 25%, which is a little bit lower, you want a little bit higher, you can change that. And then your target ROI, you can change that as well. And why would that be important? Well, one of the things you can do is you can hit this graph button, and what it's going to do, it's going to graph all the trades that you've picked for your ticker symbol. So we'll do a live example here. These shapes refer to different strategies. So spreads are circles, Venus butterflies are diamonds. And what's cool about this is the break even is down here in the bottom. So obviously, the closer the trade is to our existing closing price, that'll give you a higher probability for your trade to work out. The higher on this y-axis is the log scale, the higher the ROI. And these little lines here, this is the expected move. So also on this channel, I'm going to jump back here for a second. The expected move calculations are all calculated for you here, with the percent, the dollar move, the price movement, all that's there. But it also highlights here in yellow where that price level is. So just by looking at this chain, and even looking down here, this yellow line is the edge of the expected move for the call side and also for the put side. So you got that on both sides for any expiration that you pick. You can hover over here. It tells you the day of the week that expiration is. And since we do S&Ps, this is a Friday expiration. There's a Thursday. So a lot of details in there. But the cool thing is it's like you can pick, I don't know, let's just pick, I don't want to pick anyone here. Let's just pick, what is this one? This is a 132, it looks like. So it jumps here to the tab and takes you straight to the page of the trade where it occurred, so you get more information on it. It tells you the strategy. It tells you the call or put trade, the strike, the delta, the cost, the reward, ROI, percent from close, the break even, the deltas. This is a trade comment that you saw on the comment on the graph. Your short ratio, the trade number, the rank, all that kind of good stuff. But the nice thing is here, I can click on that trade, hit Control-C for copy and paste, and I can jump right in here into TOS, and then I can just hit paste and then analyze, and voila, we have our trade in about 3 clicks. And you can say, do I want to take that trade or not? Go back in here. So I'm going to take maybe a different trade. So I go back in here and say, okay, I'm going to pick something on the put side here. Let's see, I need a diamond. Let's do the Venus butterfly. Let's do this one. So here's a Venus butterfly on the put side. Again, same thing as copy. And I'm going to paste it straight in here. There's the puts, analyze, and voila, within three clicks. Try to keep to the KISS principle here. There's a nice Venus butterfly here all set up for you, and then you can tweak it from there to your liking. So that is what this does here. So Master 2, so Master is what it's basically doing is doing about 13,000 trade combinations and then putting all the best trades on Master 2. And there's a ranking here. So there is a stats that happens here. And like I said, this is showing all the different strategies and the score. So the score is basically if that short ratio for your butterfly. So there's, all these different butterfly types. Well, if it's above that 33%, you get 1 point. If it's within the expected range, you get another point. And then if you get above the ROI of, in this case, 400%, then you can get up to 3 points. So that's a 3 score, 2 score, 1 score. These are all the trades that are combined. This is just all the calls. These are just all the puts here in red. So calls in green, puts in red, and then the black is basically the combined. If you don't want to remember all that, if you just hover over your strategy here, it tells you that same information that we just looked at. It's a little bit smaller, but it gives you, say, hey, I want to go back here and I want to look at the 4x2s, and then adjust from there. And then you can see the same information here. Let's do example. Let's say let's see, let's do Tesla. There's plenty of activity here in Tesla. So this is in live action here. If you got a high single core processor, there's a lot of VBA behind here that's working behind the scenes. It uses an API interface to get the information, and then does the calculations with the trades. It takes around 15 to 30 seconds. And then from there, you can kind of tweak it. There's finishing touches. So now we got everything here for Tesla. You can see our other page updated accordingly. And then from here, you can decide how many trades you want to look at. You pick a lower number, 100. If I do a lower number, it will graph it pretty quickly. 1,000 trades usually within 3 to 5 seconds. So here, there's all the trades. These are the top 1,000 trades that we have here for Tesla. Now you will notice that some of these are not labeled. These make the criteria that we talked to. So we're just looking at the ones that have the highest score factors. That's why you can see the shapes. The little dots here is basically background noise. You can still do those trades, but they're not as profitable. But you notice, and Tesla's a good case here. This is 1,000 trades. You can see that the break even is way out there, right? Here's the lines for expected move. So this is the Friday, May 9th expiration. This is expected move as far as the percent. Friday here would be the next expiration, the 16th. So that's a week out, and 2 weeks out, which is the green line. So depending on what flavor that you might want, you can tweak this. In this case, I'm just going to tidy this up here just a little bit, so you can manually override the access here. Some will be minus 20%, and then maybe go up to, I don't know, here let's do 10% on the upside. And the y-axis I can also increase as well. I'm going to say up to 5,000, and you can turn on and off certain strategies here. I'm just going to leave all these on. I'll take off. I'll really move that in there. Friday. So you can select and mix and match what you want to see or not see, and just hit graph again. And it's going to do the same thing, but it's going to kind of do zoom in here just a little bit so we can see it a little bit easier. So now we can kind of see things a little bit easier. It's like looking at the stars, and so same kind of concept here. With the 1, 3, 2s in here. What else we got in here? Here's the bionic butterfly. Let's take a look at that one. So again, just click on the dot, hit Control Copy. And I gotta go to Mr. Tesla here. Let's get rid of the old stuff. And then we can just do paste and analyze. And within the 3 clicks, we get a nice little bionic butterfly going on here for $1. And again, we can kind of validate that and change our expiration to get our range. So for basically $1.05 risk, you can see it's a pretty high probability trade. You get a pretty nice room here. So this is, like I said, a nifty little tool that's been in the back of in the kitchen, so to speak. We're about 85% done. I got to do some more stress testing on it and try to break certain things to make it more robust. But for the most part, it does what it should do. But it gives you, some nice trade candidates, so you can quickly find your trades and stuff. So if you got any questions, go ahead and type in the question box there. Happy to address them, or if you got suggestions, we can do that as well. I'll want to share the config. So the config, you put in your login information here. The gray areas are blacked out because that's your login information. And you can just switch from here. And I'm going to switch over here to TastyTrade, and then you come back to chain. And I'm going to pick, let's pick Netflix. Now, while it's getting this information, you notice that this turned into TastyTrade mode. So that's where you know this will change to Schwab mode or TastyTrade. That's what tells you what mode that you're in as far as the API. I will say that the TastyTrade API is not as fast as Schwab, but you only have to set it up once and opt in, and you're done. I will say for Schwab, you got to go in and reset that on a weekly basis. It's only good for a week. So now everything just got updated with Netflix, but we use TastyTrade for the information. Everything works the same. We can go to our stats. We can see, you know, where things kind of lie. So as far as, you know, looking at this, I could say the Venus butterfly here, these 25 by 20s are probably the most, the 5 by 4 strike ones got pretty good scores. So then I could use that, and again, it works the same way. I'm going to do 2500 here, and let's do graph. So again, you got your expected moves all down here. You see them in yellow, and performance pretty good. So running on a laptop, it runs probably twice as slow. I do have a development computer that runs 5.6 gigahertz. It's about 25% faster than this. This is my kind of the main PC. The development one's quite a little bit quicker. So now you can kind of see the trades kind of, you know, laid out, and then same thing here. We can kind of, you know, look at different type of trades that we want to do. Put butterfly, Netflix, copy. Unfortunately, you know, Tasty doesn't allow you to do the same thing here with the Thinkorswim does. And now we got a nice little butterfly on the downside, and there's our risk right at the edge, and for our $1.43 ratio. So nifty little upgrade I've been working on. Like I said, hopefully in July I get everything nailed down, get it released. But that's a little demo under the hood there. It's coming down the pike. So if you have questions, comments, or anything, shoot me an email. I'm happy to address it. But like I said, the last couple of years I've been trying to figure out how to build this thing. It's a wildebeest to say the least, but nice little upgrade tool for everybody. So it will be for sale, like I said, in the store. So like I said, more details to come. But yeah, if there's anything else, will this work with TradeStation? Doesn't work with TradeStation quite yet, Jason. The API, and that's a little bit more sophisticated. And I didn't do it for TradeStation because I'm not a fan of their option platform. I've fought too many times with their margin department just doing simple butterfly type stuff, and after the fourth time I was like, I'm just not going to call them. They just don't understand. It's like they want like 25K margin. It's like the max risk of the trade is like $1,200. It's like I'm not paying 20 times more for them. So yeah, I'm just not going to do it. Interactive brokers. That's probably a good one that I probably would look at next. That I will make note of that. I don't know if I'll get in for this release, but that would probably be the most likely next candidate that we can put in there. But yeah, thanks for that, Ellie. It's a good suggestion. Do you have to have Tasty or Schwab open? No, you do not have to have either platform open because you're using your API credentials on the config tab. So once you set that and save it, then you're off and running. You know, if you're using Tasty all the time, you never have to do that weekly. You can see these little timers here. The API that I used to use it to kind of just benchmark it from all the development I've been doing just to keep the runtime down. But this will go down to about probably 12, 15 seconds on my fast one, but my laptop's running at 3.8. It may be 30, 35 seconds. But yeah, it's a lot of behind the scenes, a lot of tight code, as I like to call it. So, what is the main engine? Oh, yeah, I forgot. The main engine is it's using a Python engine. So there's a Python plugin that you have to get. You have to install that in your Excel. I've tested this on 3 different platforms I'm running Windows 10 here. I've run it under Windows 11. This is Excel 2010. I know it's an old one, but I like it. I've also tested with Excel 2019, and I've also tested with Excel 2021. They all work fine. So if you got some other configuration, I'm assuming I don't have an Apple product, so I assume it should run under Parallax or whatever the emulator is, but it should run fine under that as well. Does it come pre-populated? Sure, I don't know about pre-populated. The blue areas are input boxes. So where you see the blue box is something that you can change. I did try to put some comments here. So as far as the short ratio and the target range, when you hover over it, it'll tell you, what it is, type of thing. The strategies give you the summary, the number of contracts, or the expiration here on the expiration 5. They'll give you all the expirations. And I put the day in there because it's like with the S&P, you got expirations like every day. It's like, I just want to know like the Friday expiration, or I just want to know the Monday expiration. So I just stuck that in there. And then you can just pick from the drop down, and it'll refresh with that information in there. All right, cool. All right. So with that, we'll leave you with it, but thought I'd give you a little sneak peek, things to come. But I think it's give me a good little tool just to go to the next generation, with the dashboard. But we'll leave with that, and